So the Tequila crisis was a Mexican currency debt and repayment crisis. And if you look here, so the blue line is the upper bound of Mexico's currency peg. It had a crawling peg at the time. The orange line is the bottom edge of the peg, which never came into play. Essentially, you'll see that in 1994, the Mexican peso traded at the upper end of the crawling peg as investors lost confidence, and then kaboom. Mexico couldn't maintain the peg, and the peso went free floating and promptly lost 35%. In fact, actually, over the course of 1995, it more than doubled. So, yeah. And these are Mexico's foreign exchange reserves. You'll see how there was a massive capital outflow throughout 1994, leading to the crisis at the end of 94. And then the IMF came involved, and rebuilding of confidence through government austerity measures led to renewed inflows, helped by the fact the Mexican peso had halved. And these are foreign holdings of Mexican equities, and you'll see huge outflows. So huge hot money outflows throughout 1994. Okay, so what caused this crisis? Okay, so its origins go back to 1982. And you remember that this is the period when Paul Volcker was raising US interest rates to 15%. That had absolutely enormous knock-on effects for emerging markets. If you could get 15% investing in the US, why would you invest in emerging markets? So there was a huge emerging market debt crisis. And in 1982, Mexico nationalized the banking system. But then, moving forward to 1992, so 10 years later, Mexico has joined NAFTA and therefore has eliminated most capital and exchange controls. But in order to reassure investors, has pegged the Mexican peso to the US dollar. Then in 1992, it decides to reprivatize the banking system. But when it reprivatized the banking system, it wanted to ensure high privatization proceeds, but also the continuation of soft loans to politically favored entities. Therefore, it stopped foreign banks from bidding, stopped foreign banks from actually competing in the Mexican banking system, and it sold off roughly 70% of Mexican banking assets. So what you had was a monopoly sector that was protected from foreign competition, and they allowed essentially anyone to bid for a bank. You didn't have to have any experience in the financial sector. So potentially incompetence running the banks. As you might expect, a huge credit boom ensued. There was also deregulation, and the new regulator was inexperienced, didn't really know what they were doing, so just let everything go. So the consequences were, you'll see here that the far right-hand column, by 1996, 50% of Mexican banking loans were in default of some kind, default or restructuring. So huge bad debts. So the background is bank deregulation, huge credit boom. And that was in 1992. In 1994, the crawling peg starts to come under pressure. The US is raising interest rates at this point. Mexico is having a general election, which is contested and fraught with political violence. There's a series of assassinations. Investors start to lose confidence in Mexico. In response, Mexico issues US dollar debt. So it's saying to investors, don't worry about the Mexican exchange rate. We'll repay you in US dollars. And it issues these tesobonos, which are short-term US denominated debt. Now remember, short-term debt is dangerous because you rely on capital markets always being open so you can refinance them on demand. Then in November 1994, $3 billion leaves the country as investors start to lose confidence, and 1.8 billion departed in a single day, the 18th. Then 1994, the new government tries to reassure investors they're not planning to devalue the peso. And just the phrase devalue the peso leads to a crisis in confidence, so that the next day 855 million leaves the country. The government then tries to raise interest rates to 15%, but essentially it's just not credible. In the lead up to Christmas, 4.6 billion leaves the country, i.e. half the country's FX reserves. And on the 22nd, the government gives up and the peso is allowed to float, and on that day settles down 35%. There was then an IMF rescue package, followed by a US orchestrated 50 billion rescue package, and that allowed Mexico to repay its tesobonos. Otherwise, it would have defaulted. Then in March 1995, the new government launched an austerity drive, and that reassured investors, and money started to flow back into the country, as you saw from the earlier charts. So this is the performance of the Mexican economy, and you'll see in 1995 you had a 6.2% drawdown, a big recession, and the budget balance and inflation hit 35% in 1995. So a big recession. So in conclusion, whenever you see deregulation, that always leads to a big credit boom and a subsequent financial crisis. But relevant to us now is the fact that rising US interest rates cause huge stress in emerging markets. And the speed with which US interest rates are rising is going to be causing a lot of stress in EM. We've seen Sri Lanka default on its debts this week. Watch this space. This could get a lot worse. Yeah. Finally, crises occur very quickly. You know, the speed with which the Mexican debt crisis occurred took everyone by surprise. You're losing, in the course of 2 days, Mexico lost half its FX reserves. And then the next day, it had to let the currency float. So you need to be early, or you need to be very fast.
Yeah, and I think that's really interesting, Keith. So thank you very much for that, because I think understanding how crises of the past operated helps you have an insight into what might happen this time around, but also, as you say, gives you some clues as to what you need to do to protect yourself, because you can't actually predict either when or what the crisis will be. And as we probably all know, moving fast is very, very difficult for a private investor to do, because we do not have access to the markets in the way institutional investors do.
Yes,
and moving
absolutely.
fast is inevitably, when everyone else is trying to move fast the same way, very expensive.
Yeah.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.